The focus today will be on corporate finance and the choices in terms of capital structure and how can physical climate risks have an impact on these financing decisions. So when we talk about physical risks, we are talking about this kind of things. So you could have, for instance, a destruction of your assets or problems, for instance, in your supply chain. So this is the kind of problems we will be focusing on. And you probably already know that, but really quickly, these risks, we have to distinguish them from transition risks, which are changes or potential changes in the regulation or new technology arising and threatening certain sectors. But we are not talking here about transition risk, we are talking about physical risk. And as I said, we have a corporate finance approach and we want to understand financial structure. So in corporate finance, we have a theory which is the trade-off theory, saying that basically each firm has an optimal level of leverage, which is a balance between expected gains of having more debt, so basically having more interest which are deductible, so lower tax payments, and expected cost of having debt. And of course, if you have a new risk which is arising, so here namely physical climate risk, all else equal, your balance should shift towards less leverage. So that's the theoretical framework we have in mind. And with that in mind, what we find is that these physical risks, on the recent years, they have the effect of decreasing the leverage ratio of firms. So it's a post-2015 effect, and it's consistent about when we use multiple definitions of leverage, so book leverage or market leverage. It's also consistent when we use several definitions of physical climate risk. And these results, they are in fact driven by high-risk firms. So no effect on firms which are just slightly risky, but effect on firms which are highly risky. And yeah, there is at least partially a supply effect going on. So basically lenders being less willing to lend to these kind of firms, these risky firms, or willing to lend, but only if there is a higher price, so higher interest rates. And there seems to have a differentiated impact between bank loans and bonds. We'll see later what could be possible driving forces. So, as I said, we have an effect which is an effect on the recent years. So we can try to understand why. So first of all, of course, you have COP21 happening in 2015, and related to that, the World Bank carrying out an action plan, which is a plan of huge investments, so $29 billion annually on a 5-year window, and associating quite heavily the private sector. I don't know if you can see it here, it's written 13 billion coming from the private sector. You have also increased banking, thank you, increased banking supervision, which is going on. So, for instance, the statement by the governor of the Bank of England, McCartney, saying that climate risks are a threat for financial stability, and because of that, central banks should be really careful about this type of risk. Yeah, so moving to the literature existing on this kind of topics. So I would say that there is really well-documented evidence on the macroeconomic side about the impact of weather conditions and economic development. So for instance, you have this striking figure relating temperatures and GDP per capita. But you also have this study by Xiang and Gina in 2014, saying that the annual growth rate of world GDP declined by 1.3 percentage point, so per year, of course, due to cyclones on a period covering almost 40 years. But us, or at least me, I'm more focused on corporate finance, so firm-level studies. And these firm-level studies, so far, they have been focused primarily on CSR. So saying that, for instance, if I'm a firm and I'm producing some externalities, negative externalities on the environment, I would tend to have a higher cost of capital. Or if I have good CSR performance, I would tend to have a lower cost of capital. But maybe this literature disregarding a bit physical risks and transition risks. And you have a recent study by Kruger and co-authors saying that investors, they are in need for more information about these risks, and they are having difficulties to price them. There is a paper which is quite similar to our paper, which is a paper by Elnas and co-authors finding similar results. So they use natural disasters, and they find that these natural disasters are associated with less leverage. But we are different in several dimensions to their study. So first, they include things which are not related to the weather. So for instance, earthquakes, we only focus on weather events. And they are using past realizations of, for instance, earthquakes or cyclones, etc., whereas we are relying on a forward-looking approach. I will explain that more soon. And as I said, we are having effects on the recent years, so of course we need to try to understand if we are just making that up or if other people are finding that as well. And indeed, some people are finding that as well. So for instance, you have focusing on transition risk, the study by Delis and co-authors finding post-2015 an effect of transition risk on the interest rates which are charged on bank loans. Or the study on green bond by Zerbib finding that after May 2016 you have a negative yield premium. And other studies finding also an effect post-2014 or 2015. So now, explaining more the data we are using. So we are using data coming from a French company, which is Carbon 4, which developed a methodology, which is a CRIS methodology, with the help of several institutions. And what they want to do is to compute a risk rating from 0 to 99 for each firm of the MSCI World Universe, roughly. So what they know is that a company is, for instance, in a particular industry and is, let's say, operating 60% of its activities in Japan and 40% of its activities in the UK. So they know the industries, they know also the countries in which the company is operating, and for each of this country in which the company is operating, they rely also on data from the World Bank, so projections of future weather realizations. So they do that at an aggregate level and also at a sub-risk level. I'm not sure you can read that. So they have 4 extreme risks. So for instance, heat waves or storms, etc. And 3 chronic risk. So for instance, change in the average temperature. So as I said, these data, they are going from 0 to 99, and if you have a high grade, it means that you are exposed to a high risk. So high risk of climate change. Doesn't mean that if you are operating in Qatar, you are having a bad grade in terms of heat waves. It means that you are only having a bad grade if you are operating in Qatar, only if Qatar is exposed to future changes in its heat waves. Yeah, so other information, we are using traditional sources, so CompuStat, going from 2010 to 2018, excluding financial firms. And we end up with 1,200 firms with a little bit more than 10,000 firm-year observations. So in terms of descriptive statistics, so what is important to notice here is that these grades, climate grades so far, they only exist, are computed for 1 year, which is 2015. So the underlying hypothesis we are making here is that on a short time frame, the climate risk exposure should not change too much. So we are using the same grade for the same company throughout the sample period, 2010 to 2018. So, and what we notice is that, so this is the general grade, so climate risk, and then you have the 7 sub-risks. And what we notice is that for most of these ratings, the mean is between 25 and 40, and standard deviation is about 10. So this is what we will use after for computing marginal effect. We will just say what happens if we increase the grade by 10 points. So about summary statistics for financial variables now. So I think nothing special here. Book leverage being at 21.5%, market leverage being at 14%. And yeah, we include in all regressions these controls, so EBIT, luggage, Tobin Q, OPEX, R&D, proportion of tangible assets, size of the firm, issuer grade, which is the credit rating, going from 1 to 20 and set to 0 if it's missing. And this one, the other ones being just added in some specifications. So, and then if we define 2 samples, so low risk if you are below the 40th percentile, and high risk if you are above the 60th percentile, we notice that high risk firms, they tend to have less leverage. So now this was just univariate. Now if we move to multivariate analysis, what we notice is that all else equal, if you increase your risk by 10 points, so roughly 1 standard deviation, all else equal, you have a decrease of 1.2 percentage point in your leverage, book leverage ratio. So you start at an average value of 21.5, and it means you would go to 20%. Yeah, and these are the results. If you use book leverage as the dependent variable, similar results are going on if you use market leverage, or similar results if you exclude the most represented in sample industries, or if you exclude carbon intensive industries. So for that we use a recent paper by Ilan and Carters, where they have a table, I think in appendix, where they say which are the 15 biggest polluting industries. And if we exclude the 5 biggest or 10 biggest, the results are still holding. So because of that, we think that we are not capturing an effect which is related to an industry or some industries in particular, or that we are not capturing results which is due to transition risk instead of physical risk. Yeah, so in these results we are using the general grade. If we decompose into the sub-risks, what we find in a nutshell is that extreme risks, they are behaving in the same way. If you are focusing on chronic risk, the results are more diverse. We find no effect of average temperature rise risk, and sea level rise behaving just as extreme risks. So now when we split into two groups, so high climate risk and low climate risk, defined with respect to the percentile as before, we notice that we have an effect only on the high risk group. So, and the difference between the coefficient on the high risk group and the low risk group is statistically significant. So, in fact, the general results we are having comes from the high risk group. So what we had so far was firm level data. So now if we move to another data set coming from DealScan at the loan level and using the spread as dependent variable, we find that, so it's here and here, you have on this high risk group an effect of climate risk on the spread. So if you are focusing on maturities more than 3 years, if you increase by 10 points the climate risk, you have a 65 basis point increase in the interest rates. If you are focusing on maturities of at least 5 years, you have an 81 basis point increase. Now using all the data at the bond level this time, focusing only on vanilla fixed coupon bonds, we find a similar effect, but to a lower extent. So we find, depending on the specifications on the high risk group, between 22 and 23 basis point increase if you increase by 10 points your climate risk. So I think to conclude before concluding, two remaining concerns. So the first one would be that maybe we are using a new measure of capturing physical climate risk, but that these risks are already captured by the credit ratings. So we have anecdotal evidence that they don't capture that. So for instance, Moody's on the municipal bond market saying that if cities are not carrying out enough efforts to tackle climate change, they will get downgraded. But 1 year after, no downgrade took place. We find support for this anecdotal evidence. So on the first two specifications, we are focusing on the level of the credit rating. We find no association between physical climate risk and the level of credit rating. On the specification 3 and 4, we are focusing on the probability of getting rating, so no association. And the last three specifications, probability of getting an upgrade, downgrade, or just an updated rating, no association either. And last results before concluding. Another concern could be that we are capturing a CSR effect. And so to mitigate that concern, we are using several data sources. So if we use MSCI IVA, so general CSR score or environmental pillar score, we have no same effect as before. And if we are using CDP, so is a company answering or not to CDP, to the CDP questionnaire, so a dummy equal to 0 or 1, 1 if you answer the CDP questionnaire. So same result, or same result if you are on the A list, so you have the best grade from CDP. Yeah, so to conclude, we have a corporate finance approach, so we are focusing on financial structure choices, and we do that because we are focusing on long-term debt, and climate risk are particularly relevant on the long term, and we can rely on the trade-off theory to have a theoretical background for that. But we still have, to some extent, also effects on cash holdings and dividends, but they seem less strong. So the main takeaway is that climate risk is associated with a lower leverage in the recent years, so post 2015. And this is consistent with several other papers finding post 2015 effects. And so all results are robust to various definitions of leverage, so book leverage, market leverage, of climate risk, so the general grade or sub-risk, and to various levels of clustering. So what we have presented was clustered at the firm level. If instead you cluster at the country, industry level, it's the same. And results driven by high-risk firms, which face higher cost and mainly on the bank loan market. So this differentiated impact between bank loan market and bond market could be rationalized at least by two explanations. So first one would be that the level of credit ratings does not reflect climate risk. And the second one would be that banks, they are faced with the threat of new capital requirements regarding climate risk. And because of that, they are less willing to lend to firms which are risky climate-wise. And yeah, all results all after taking into consideration CSR or CSR transition risk. So that's it. Thank you.